Hello everybody. So this video is entitled 4 Fallen Small Cap Growth Stocks. Cheap growth. Is there cheap growth? And this video was inspired by my update of my entire spreadsheet. I have more than 200 stocks that I track. I mean, at least I try to update every quarter of a spreadsheet. And, 4 stocks out of there kind of, caught my attention as being fallen, i.e. they dropped quite a bit, and they are dirt cheap, and, they fit my metrics. So the EV over GP over RG on all these 4 stocks is low, and they achieve a rule of 40. They have EBITDA margin profitability, and they're fallen stocks. They're down. They're quite a bit down. And, of course, there's a lot of hyper growth stocks right now that are down. It seems like the market is consolidating over the big caps and entirely ignoring these smaller companies who, in my view, are doing very well. So the first example is ON Holdings. So ON Holdings, you can see November 2021 we were trading at $45. Today we are trading at $45. So the stock price has not changed in a matter of nearly 4 years. 4 years, right? 4 year-ish. Yet if you look at the revenue over that same period, that 4 year period, the revenue tripled. We are now at 3.6 billion in revenue trailing 12 months. So more than tripled, 3.5x revenue, stock flat, right? So to me, that's a good sign, and that stock, of course, called ON Holdings. They've been buying back some shares lately. The last 2 quarters, they've been buying back some shares, although the shares have been very well managed, very little dilution. We were at 635. We're at 655 at the peak. We're back at 640-ish, so very, very low as far as dilution goes. And, this stock, if you look at their outlook in their shareholder letter, the CEO is guiding for 34% year-over-year growth, 62.5% gross margin. These are high-margin products, and 18% adjusted EBITDA. Now, I'm using the numbers from the analysts here, so I'm using the prior EBITDA. I put 14, so you can see I'm conservative. 62%, I'm using the same margin. And my forward growth number is 31%. They're actually guiding 34%. So if the analysts are more conservative than the own guidance of the company. So actually, you see, I'm conservative, and this stock is at a 0.2, call it a 0.19 if you were to take the company's numbers. And of course, it achieves a rule of 40 at 45. A rule of 40 is the growth rate plus the margin. And if you add both, you need to have more than 40. That's what VCs use when they assess whether they should invest in a venture or not. And briefly about the company, what does the company do? Of course, they do these expensive shoes, which I'm sure if you live in the West, well, anywhere really, I'm sure you've seen these shoes. And, it seems like they've taken the athletic flair from Nike. Nike is not what it used to be. It seems like the brand that is quote unquote in right now is ON Holdings. There's also Hoka, but you can't buy a pure play Hoka. You have to buy Deckers Outdoor, which is includes other brands. Not as interesting in my view. Very pricey shoes, and because they're pricey, you can pay the tariffs. I think they make their shoes in Vietnam. You can pay that tariff easily because you sell an expensive product, right? So the tariff don't impact you as much. Plus, they do a large percentage of sales are DTC. They're one of the highest DTC companies out there. They have their own stores, they have their own website, they sell a lot on their own without the help of anybody, right? That's not something Nike can say. Their shoes, in my view, have become kind of a status symbol. It's kind of like the Lululemon of shoes, I guess. At least that's my feeling that I get. And they have a very interesting ownership structure, where they're not founder-led anymore, although they have co-CEOs, and the ownership structure is interesting. I don't understand it all, but it pretty much guarantees this Swiss control for decades to come. And so they're very long-term oriented, building the future. They have another catalyst. They're getting into apparel. They're getting into shirts and active wear and all that sort of stuff. So to me, I find this stock very interesting, and it hasn't moved in 4 years. We're at the same level we were 4 years ago, but the company 3.5x revenue. So I don't understand this. I find this stock dirt cheap. I am interested in this company. Okay, let's move on to another company, another fallen hero. This one has taken a much harder fall than ON Holdings, although, technically if you're flat for 4 years, that's no good. This one's worse, right? This one was divided by 3. in a matter of 4 years, divided by 3, and actually it's divided by 4 in a matter of 1 year. So the stock is down 75% in 12 months, something like that. And that's the trade desk. And why is the stock down? Well, the stock is down because the market is fearful of the competition from Amazon and Google. And I would say it's particularly fearful of the competition from Amazon because Amazon is launching some sort of a demand-side platform. And of course, the trade desk is the neutral demand-side platform. And so, of course, as we know, Amazon disrupted the grocery stores. Grocery stores are dead. There are no more grocery stores. You know that, right? So, of course, the narrative now is Amazon's going to disrupt the trade desk. Amazon's going to disrupt HIMS. And my view on this is that this tends to be over-exaggerated. Always over-exaggerated. Sure, Amazon is a formidable competitor, but the trade desk is a founder-led company. They actually are still, despite the 75% drop, they are still performing 50% more than the market. Before that drop, they were one of the best performing stocks out there, right? And you could have put it in the top 10 with Tesla and stocks of that sort. And, they have a lot of catalysts. So what do? Of course, they are a platform for ad buyers. They're an ad buying platform. Your brand, you want to sell your product, you go to the trade desk and you have this neutral ground where you can buy advertisement through all of the channels. You can do in-site advertising, you can do audio advertising, you can do online video, connected TV, display, out of home advertising. So maybe a billboard. Billboards are moving digital in the towns. So they're taking and even print advertising, or even if that's, I don't even know if that's still a thing. I don't think that's much of a thing anymore. But even that is being sold on platforms, on DSPs, demand-side platforms, and they are the more neutral ones. They are the most neutral ones. So that's point number one. Sure, there's some competition on Amazon, but it's not a big deal. They have two big catalysts. That's why they're predicted to grow 20% over the next 12 months. The catalysts are CTV, connected TVs. 90 million households have connected TVs now. It's twice as profitable as broadcasting, like what I call linear TV. It's like twice as profitable to advertise on there for a company like the trade desk, and companies actually advertise much more on connected TVs. That's why you can't buy a connected TV anymore these days. Where you turn it on, you have an ad. You always have an ad, right? And these connected TVs, they are so sneaky. They've done updates where they turn off automatically after 5 minutes, so that they make sure that you have to turn it back on multiple times a day. Every time you turn on the connected TV, you have an ad. Who's selling that ad? Well, it's likely the trade desk. It could be another stock I covered on the channel before. It's called Viant, right? It's the DSP, is the ticker symbol. I've covered that stock. Some of it could be bought through Amazon. Some of it could be bought from Google. Of course, these two control a lot of connected TVs. But, nonetheless, in my view, you're always going to have a neutral player. There's always going to be room for a neutral player. That's point number one. Point number two, over catalyst for them is going international. They are growing internationally. They are very prevalent in the US. They have the world. The world is their oyster. They can grow pretty nicely in the rest of the world. The buybacks, the shares outstanding are fine, barely any dilution. So this drop is really due to sentiment. And I think the sentiment is, Amazon's going to kill them. I think that's the sentiment. Competition's bad. That's the sentiment. And I find it interesting right now. I mean, EV over GP over RG is definitely the more expensive one out of the 4 stocks I cover today. But it's still cheap at 0.3. Rule of 40 is a 42, right? So more than 40. We're talking about 20% EBITDA margin, 79% gross margin, and still growing. Founder-led, history of superior returns. I like this stock quite a bit, and it's down 75%. So even the medium to short-term investor may be interested in this company to play a rebound. So I find this one quite interesting. Moving on to a third stock. So this some people will say is perhaps the riskiest stock I'm showing here. But honestly, I'm not sure I see that much risk in this stock. So it's gambling.com. And the reason why I say I'm not sure I see that much risk is keep in mind, it's trading at 1.3 times forward revenue, 1.4 times forward profit. It's trading at 5 to 6 times trailing 12-month EBITDA. So the stock, the stock is so dirt cheap. It's down 65% since the beginning of the year, but it's actually down more if you go back a little further out. This stock was trading, $15 at one point, right? So it makes very little sense. It was sold off. Why was it sold off? Well, you may remember the AI narrative in early 2025. It affected Google too, right? In early 2025, Google was cheap. Google recovered. This stock got cheap at the same time. It never recovered because the market started saying, oh, well, people are not going to use gambling.com's properties to search for a casino. They are just going to use their AI and ask their AI. And this is perhaps a major misunderstanding of this website, in my view. So what is these websites? Because there's tons of websites that they run. I would call them the Expedia of gambling sites, or the Expedia of gambling and casinos. So that's their business. Referral is their business. And they also have a little bit of a business in subscription, where they sell subscriptions for people who want to know where to gamble, and subscriptions for these gambling sites who need to have the right odds. When they set the odds, they need to know what the competition is charging for these odds, and so they can subscribe to the gambling.com service. I'll show you where is the subscription right there. These are where do I have them here? Did I put them here? Yeah, I did. They have two subscriptions. You can't really tell, but just know that they have two subscriptions. One subscription for the corporations, and one subscription for the customers. And their websites include something like RotoWire, OddsJam. Again, I don't know that sector. I live in Texas. Gambling is not very big in Texas, so I don't really know this sector too much. But I can tell you one thing is it's a highly regulated space. They own a bunch of state-specific, and they also have some UK-specific websites that they run, like a bunch of state-specific websites and country-specific websites that are referenced in these states. And why do they do that? Because it's heavily regulated. You can't really have one website for the whole world. It's heavily regulated. It's state regulated, and so they own all of these websites. They also own gambling.com. They own another website called vegas.com. So popular for people who go there. Vegas.com. They run that. Casinos.com. They run a bunch of websites whose main purpose is to sell advertising and a little bit, right? For you can see they have 15 million advertising. So that's like the Vegas.com advertising, the bookies.com advertising. They sell ads too. That's their third business. Bigger business is a subscription business at 30 million. And then the most is performance marketing, which is their commissions based on gambling proceeds that go to these websites. They earn a commission. If you ask me, it's pretty diversified website. Tons of sites that they own. I don't understand. I don't see imminent disruption on this website because of regulation. High regulation is there, and I also see a mega trend. Gambling. Like I said, I don't see much of it in Texas because we don't have any of the DraftKings or anything like that here. But gambling in the U.S. is like really, really big, and a lot of states are all about gambling because they make money from gamblers, right? Like gambling is like a tax. They're very happy to tax gamblers, so it's actually an uptrend. And then you have predictions market coming, which they if predictions market come, they are going to increase their corporate subscription services because prediction market are going to need to know what the odds are of all of your websites. So they're kind of like an oracle, kind of like a chain link of gambling odds, I guess, if you allow me to make this comparison. So we know data is important in this type of website, right? Like we know, for example, Visa has a big data business that they sell data. So they're selling that data, which is the other advantage of running such a large affiliate program is that you have access to data, which then you can sell. They also have a small buyback in place, and they have so when they acquire, I didn't go into the weeds, but they acquired some other company, and that other company had a lawsuit on them, and so now it's like the liability got transferred to them slightly. But anyways, the market expects a settlement, and if they settle, that could be a pop in that stock price as well. So lots of catalysts. but a dirt cheap stock. I think the risk, especially the risk of AI disruption, I think that risk is priced in, given that the cash flow they're going to have for the next 5 years essentially represents the entire value of the company. So at least that is my take on this. So I like this one. It's dirt cheap. It got even cheaper recently. How long will it stay cheap? I don't know. Most stocks, as you can see. Look at Odd, look at Trade Desk. Most stocks is just like Bitcoin. If you don't want to own a stock for 5 years, you shouldn't own it a minute. Kind of my take here. At least it's this channel, right? We do long term on this channel. Anyways, finishing up with Duolingo. So Duolingo, perhaps the most debated stock out there. Perhaps right now, like a lot of people are very big on Duolingo. I'm warming up to Duolingo because it got cheaper. It got cheaper in 2025. It's now trading at the October 2021 level. So again, a stock 5 years, no return, no nothing. But if you look at the revenue compared to 21, we had 250 million. We now have nearly $1 billion. So 4x revenue, stock price flat. 4x revenue, stock price flat. Explain that to me. The market is nuts. There's no other way to say it. In my view, the market is kind of crazy. EV over GP over RG 0.25, so it is cheap. Not the cheapest, but it is cheap. A rule of 40 is a 47. And let's talk a little bit about the business model of Duolingo. One may not know this because, of course, if you live in an English-speaking country, you're going to think of Duolingo as some hobbyist trying to learn Spanish or German or whatever on a weekend. And if you look at this app in the West, quite frankly, I view it as an addictive app. I think it's a highly addictive app. I think like the way they send emails to get people to get back on the platform, the way the bird starts crying if you don't play. I think they follow a little bit of a social media addiction type stuff. I don't know if that makes any sense. So I think in the West, it's more of an addictive app, more of a game. But you have some language skills. So you learn skills while playing. Okay, fine. But I want to call your attention to the fact that Duolingo is actually very big in non-English speaking countries where people are trying to learn English, which obviously you have a much bigger incentive to be invested in such an app if you live in a country that doesn't speak English, because speaking English is kind of mandatory these days. You have to speak English, and so did you know, for example, that Duolingo is actually pretty darn popular in China? In China, they had a partnership with Luckin Coffee, where their bird married the mascot of Luckin Coffee, and that was very popular in China. They have this cute marketing, I guess I would call it, cute marketing, which really resonates with an Asian audience. Like if you know about, I don't know, Hello Kitty, have you heard of that? Like it really resonates with the Asian audience. And it really makes sense because let's think about it. Learning English is very essential, and that's the most populous region. And of course, they all need to learn English, because it's essential. I mean, if you travel anywhere out of Asia, you need to know English. And they are disruptive in English learning, in English teaching. I fundamentally believe that. In fact, if you look at, I was reading about the Duolingo English test. That's disrupting all of the TOEFL and the, TOEIC, all of the, I don't know, all of these old tests that were in place 10 years ago. It's disrupting them. Like the Duolingo test is disrupting that, and that's very interesting to me. One of the points. One of the only disappointments, I guess, that I have with Duolingo is when I covered it years ago, I thought they would get into math. I thought they would get into history. I thought they would get into science. I thought they would get into early childhood. They have a little bit of early childhood, but not a lot. Turns out the only non-language related success they've had is chess, which is pretty good. But I mean, it's a niche community. They have kind of a big community. You can create something somewhat big with chess. But I'd like them to move their app to see move their app beyond just language, like teach other things, like starts teaching math, for example. I think that would be a really big deal. Basic science, I think that would be a really big deal. And then you could turn this Duolingo story into a much bigger story where it is the disruption of education. I would love to see Duolingo actually be the disruptor of education up until, like, I don't know, freshmen at the university, or maybe up until the bachelor's. I don't know. I would love to see them be a disruptor of education and using addiction, because in my view, it's all about addiction and serotonin release, and these noises on that app are very much studied to release happiness whenever you hear them. I would like to see them turn that bird into something much more comprehensive than English. But of course, that's coming from somebody who lives in an English-speaking country and where I speak English every day. So, the value prop may be much more visible to someone who is not in an English-speaking country. Then the value prop is very valuable. So I find this talk interesting. We'll see how it goes in the next few months, but definitely interesting at this level. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.